Berkshire Hathaway controls nearly $1 trillion, and for the first time in over 60 years, they're entering a future without Warren Buffett. Most investors are asking the wrong question. They're asking, can Berkshire survive without Buffett? But the real question is this: what happens when the only person allowed to do nothing is gone? That's because Berkshire didn't win by being smarter than the market. It won by being more patient than the market. And patience is a lot harder to maintain when the legend who earned it is no longer in the room. By the end of this video, you'll understand the 3 pressure points that will define Berkshire's next decade, why even small mistakes could permanently reset its returns, and why this transition may create one of the most misunderstood opportunities in modern markets. When people think about Berkshire Hathaway, they think about stocks: Apple, Coca-Cola, insurance, but none of those are Berkshire's real advantage. Their real edge has always been behavioral, specifically their willingness to look wrong for a very long time. Buffett was comfortable sitting on tens or even hundreds of billions in cash, ignoring opportunity costs and waiting for deals that felt almost embarrassingly obvious. That discipline was tested brutally during the late 1990s. From 1998 to the peak of the dot-com bubble, the Nasdaq exploded higher, but Berkshire barely moved. Critics called Buffett outdated, and some said he was finished. But then, the bubble collapsed. The Nasdaq fell nearly 80%, but Berkshire didn't just survive. It outperformed massively in the years that followed. Buffett didn't win by timing the crash. He won by refusing to compromise standards when everyone else felt forced to act. And that mindset is what built Berkshire, and for the first time ever, that mindset belongs to someone else. So, where does this mindset get tested? The first and biggest pressure point is cash. Berkshire Hathaway sits on over $300 billion in cash. Under Warren Buffett, that cash was allowed to sit idle for years. Doing nothing was the strategy, and investors accepted it because of Buffett's track record. But Berkshire's new CEO, Greg Abel, doesn't have that same track record yet, and without decades of earned trust, Abel will face increased pressure to put capital to work, even when the best opportunities aren't obvious. If capital gets deployed at slightly lower standards, the so-called Warren Buffett premium that has long kept Berkshire stock trading above traditional metrics will begin to fade. While the broader stock market has surged more than 20% since May, the Berkshire stock has fallen nearly 10% over the same period. But if Greg Abel proves himself over time, that Buffett premium could be replaced by a Greg Abel premium. However, until then, every major capital decision carries more weight than it did before. The second biggest pressure point is buybacks. Berkshire has increasingly relied on repurchasing its own shares when Buffett believed they were clearly undervalued. But now that the Warren Buffett premium is fading, there might be more talk inside the company about buying back shares at undervalued prices. If these buybacks are done well, they will enhance Berkshire's long-term returns. However, you still need to make money, and that leads us into our third pressure: acquisitions. In the past, Buffett waited decades for the right deals and ignored entire sectors when valuations didn't make sense. That strategy worked when Berkshire was a lot smaller, but now it's a $1 trillion conglomerate, and at their size, only a handful of companies are large enough to truly move the needle, and most of them have already been carefully examined by the rest of the world. This makes it increasingly harder for Berkshire to chase mega-scaled, undervalued companies. That's what investors should really be watching. Buffett was wildly successful because he had all 3 factors under control, but even if one of these factors slips up, Berkshire's returns could become average. So, what happens next? Here's my take. I think the Warren Buffett premium will continue to erode because the markets hate uncertainty. Even if Berkshire's underlying businesses perform well, markets will still price out most of the Buffett premium. And that will make for an exceptional buying opportunity, because if that happens, the bar for Abel will be set so low that even a mediocre performance will make Berkshire outperform the market's expectations. If you found this breakdown helpful, let me know what you think happens next. And if you want more breakdowns like this, consider subscribing, and I'll see you in the next one.